Here is the common lie that everybody tells you. Just invest $100 every week into the S&P 500. Do this for long enough and then you will retire as a millionaire. You will have a nice life once you get older. But I don't think that's true. On the face of it, it seems true because the S&P 500, so the leading indicator of stocks in the US, tends to, over the long term, simply go up. So this is a linear chart, and here we've got the same on a logarithmic chart. By the way, this vertical line over here is when Bitcoin started trading. So Bitcoin actually really never has seen a real crisis, right? This is the global financial crisis. This over here is the .com crash. And here we've got the Black Friday, where subsequently everybody got poor and desperate, and where then World War II started. So outside of those kind of events, right, if we simply zoom out, things seem to be fine, right? We simply just allocate towards stocks and we wait. And if we are patient and we save enough, we should be okay. But here's the problem. This chart is in US dollars, right? Prices of stocks are in US dollars. And here's the value of $1 million over time. So this is the US dollar relative to all of the dollars that are out there, right? Relative to the US money supply. The money supply is expanding steadily, and so the value of a single dollar is declining rapidly. It's down more than 98% in this chart. And so really we need a different measuring stick. If we want to know, are stocks cheap or are they expensive, or how much is it worth buying stocks now compared to the past, we have to look at something else than just the US dollar, right? The US dollar is not good of a measuring stick because it tends to go down in value. The prices of stocks and of property and of gold, etc., they all go up, not because those things suddenly become more valuable, it's because the US dollar gets less valuable. And so what is then a good measuring stick? We can use all kinds of comparisons, right? The US dollar is not good long term, but we can use other comparisons that are also denominated in US dollars. And so then the effect of the monetary expansion gets divided away, right? One thing denominated in US dollars divided by something else denominated in US dollars simply just looks at the relative ratio without the impact of the US dollar expansion. So here's one thing we can do. The US GDP is denominated in US dollars. And what we've got over here is the Wilshire 5000. So this is a more extensive US stock market index. And isn't that ratio quite interesting? The market cap of those 5,000 stocks used to be on average roughly 83% of the US GDP. And it was at more than 130% during the .com bubble. It was at 105% during the global financial crisis or the housing bubble, and now it's at 2,000%, more than 2,000%. So relative to the US GDP, stocks have never been that expensive. Now, is the Wilshire 5000 the best approximation for the stock market? Maybe, maybe not. Let's look at others. So here's the value of public and private equities relative to the GDP. Now, since we add this up, obviously the percentage values tend to be higher. We can see how the delta between the .com bubble and the global financial crisis isn't that large because private equity tended to grow during that time. But again, we are at all-time highs. The value of public plus private equities is now 300% larger than the US GDP. Let's have a look at the Dow Jones. Also not necessarily that great. We are very high. And here is the S&P 500. So yes, the S&P 500 is close to all-time highs in US dollars, but it's not just high because the US dollar is weak. It's also high relative to pretty much anything else. We are now almost 50% more expensive compared to the exuberance during the .com bubble. Now, is the US GDP the best measuring stick? Who knows? Maybe companies also became a bit more global during this time. Did they become that much more global? I'm not sure. Now, since the fundamental problem with all of this is that the value of the US dollar is going down or that the money supply is expanding, we can also have a look at the S&P 500 relative to the money supply. That's then this chart here. And here we are actually not at an all-time high. The .com bubble had been slightly higher. So from the current value to the absolute top, it's roughly 20% that we had been more elevated. in the past. Now those movements matter. The dot-com crash with the subsequent housing crisis led the S&P 500 relative to the money supply decline by 75%. You invested $1 at the height of the dot-com bubble and you sold this during Lehman Brothers. You have lost 75 cents on the $1. Now, if we mathematically remove the monetary expansion and we look at things like the US GDP, we suddenly come to realize that actually people are not doing that well. It seems like overall we are expanding, right? The economy is growing. But when the GDP is only growing, say, by 3% and the monetary base expands by 6 or 7%, on average, by the way, it was 6.8% per annum, then did we really gain? I think the answer is no. The US GDP, which is measured in US dollars, tended to grow slower than the monetary base. And so the output in hard goods actually went down. If you have it worse today compared to your parents, then that's actually not a surprise. This here is the US GDP divided by USM2, by the money supply. And since 1997, this is going down. By how much? By 40%. If you've got a living standard that's 60% of the living standard of your parents, then you're doing pretty much average. This is why you can't buy the house and why your parents were already considering buying the second house. This is why you don't have children and your parents were already considering having the third or fourth child. It's simply way tougher now, objectively. Now, on top of that effect, on top of the effect that less stuff gets produced, less services get provided compared to 30 years ago, we've also got capital concentration, right? The richer get richer, the poorer get poorer. And the reason for this is that rich people have more ways to accumulate even more wealth. For example, buying a house, right? Let's say you take out a mortgage. You've got 80 or 90% of debt and you finance that debt very low, say with 3% per annum. When you've got that much debt, many years of income in debt, finance at these very low levels, and at the same time the monetary base expands by 7%, that means that the value of your debt is shrinking. So effectively your net worth is going up because your debt is getting devalued. You are profiting from the monetary expansion because you have debt. And so a decline of 40% in the US GDP over the last 30 years, if the monetary base wasn't to expand, is actually just the average case. But it's the average case, it's not the median case, right? The typical Joe probably lost even more than 40%, again, because capital concentrated towards the people that knew how to play the game. Now in this video, I don't want to talk too much about the potential solution. There are many solutions. Bitcoin might be one of them. I simply just want to raise awareness, right? Whenever you see US dollar comparisons over long periods of time, put very large question marks towards that. Whatever you're buying and holding over the very long term needs to appreciate by at least the monetary expansion, the 6.8% per annum. If you buy something that doesn't go up as quickly, if you buy an investment that doesn't return as much, then probably you're falling behind, probably you will be losing. The solution right now is probably not to buy stocks. We have seen how, relatively speaking, they tend to be expensive. And short to medium term assets like Bitcoin might also not be that cheap. It's important to ride the waves. It's important to buy the thing that's currently not very hyped. It's important to buy the things that nobody has on their radar. Now, here's the thing. There are plenty of topics within crypto that aren't very sexy, but that are, I believe, very vital to make money long term. For example, concepts like correlation. What we see over here are correlation coefficients. Did you know, for example, that most altcoins tend to be more correlated with Ethereum than with Bitcoin? In other words, it's not when Bitcoin goes up that the altcoins go up as well. It's rather when Ethereum goes up, then the altcoins go up as well. Or did you know that the correlation coefficient of the S&P 500 to Ethereum and thus the altcoin market is actually quite volatile? In other words, it does make sense to also own stocks, not just Ethereum, not just crypto. The common narrative is that when traditional markets go down, that crypto tends to go down as well, right? That crypto is simply just a levered bet on, say, technology stocks. That's not the case. The correlation coefficient is relatively close to zero. Or do you know the long-term expected returns of various asset classes, of say gold, of say the S&P 500, of Bitcoin, of altcoins. When we don't just own crypto, but we also own property, for example, and we've got that portfolio, what kind of returns do we need in order to beat monetary debasement, but also in order to at some point to get financially free? How much money do we need to have enough passive income to not having to work anymore? What are expected long-term returns, and how much should we actually allocate towards crypto and towards property, towards stocks, gold, bond, etc.? What actually makes sense? When there are tens of thousands, hundreds of thousands, maybe even millions of dollars on the line, not having this properly nailed down is a huge problem. And when the market isn't that great anymore and the upside for Bitcoin could be somewhat limited, how can we still make money? How can we make money from charts like this? What we see over here is Balancer relative to Ethereum. We can make money by shorting this. Balancer has very bad tokenomics, the supply increases over time, and so it tends to do worse than Bitcoin and Ethereum over the long term. And we can make money from that, again, from the relative valuations, not just from US dollar valuations. When we look at how quickly is the monetary base expanding, and we put this into relationship to how quickly are salaries increasing, we actually see that pretty much everybody is falling behind over time. And this is not just true for the poor people, this is even true for the top 5% of earners. By the way, if you earn $500,000 per year, then you are in the top 5%. But yeah, data like this is useful. And those are not necessarily the sexy topics that work well on YouTube, right? On YouTube, it's the 100x altcoin gems that get all the clicks. But when you talk about diversification and correlation, etc., people just fall asleep. But it's the long-term planning, the long-term proper allocation towards different asset classes that actually make the difference. And so have a look at all of this. Those are tutorial videos of the premium membership of this channel. It's down below, thebitcoinstrader.com. There's more than 100 tutorial videos in total. What are my favorite crypto macro indicators? How do interest rates impact different asset classes? We've just seen how the market got spooked because the Federal Reserve might get more hawkish. Or how do we adjust our returns for risk mathematically, right? Everybody can get more returns by increasing the risk massively, but the idea is we want to get the best returns for the risk. And so there are ways to calculate this using alpha and beta. Those are all very complex topics, but I strongly believe that it's the skilled people, the people that have most knowledge, that tend to make most money over time. Now, besides all of those tutorial videos, there are also various chats in premium where I try to be active as well. So in case you've got any questions, just tag me in a message in those premium chats and I try to reply. The membership is currently $165 US per month. This is not for people that only have a net worth of $1,000, right? This is for people that actually have to manage wealth in the tens of thousands, preferably even hundreds of thousands of dollars. There is a 1-week money back guarantee as well. So in case you don't like premium, just message me within the first week and I refund you 100%. There's really zero risk for you. Now, if it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video or see you in premium. Cheers.